Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello and welcome to another episode of On My Way to Wealth. My name is Luis. Thank you for tuning in. I'd like to talk to you about year-end strategies. I'm going to talk a little bit about tax planning strategies and just financial planning strategies in general that you should be aware of before the year is out. Usually every year around the fourth quarter of the year, I meet with most of my clients to go over just everything that we should be doing specific to their particular situation before the year is out. So I want to share some of those tips with you. I encourage you to talk to a financial planner and or a CPA or enrolled agent, someone who knows both taxes and financial planning, because there's a lot of information that I'm going to give you that can help you legally lower your taxes. And that is the goal of tax planning in and of itself, is how do we lower our taxable income or take advantage of the current tax code to our favor, basically, legally, right? So let me tell you a couple of things that I discuss with my clients. One of them is, for those that are W-2 employees, we take a look at whether or not they have contributed enough to their 401k or maxed out their 401k. That's usually one of the main goals of my high earning clients, to lower the taxable income today, is to max out the 401ks. Currently for 2023, if you're under the age of 50, the limit is $22,500 with a $7,500 catch-up contribution for those that are 50 or older. So $30,000 total. So now that there's a few paychecks left during the year, we kind of take a look and say, okay, how much have you contributed so far? Usually we plan out earlier during the year to make sure that we max out before December 31st. But if for some reason that has not happened, then it still gives us some leeway to figure out what could be done within the next couple of paychecks. You know, some people have 5-6 paychecks left, depending on how often they get paid. So we can adjust the 401k withholding accordingly. So that's one thing to look at. If your goal is to max out your 401k, be aware of the limits and also be aware if you're on track or not. Some employers actually cap your contribution if you over contribute. They don't let you over contribute, but I've seen some employers that don't. So in fact, you could have the opposite problem where you over contribute. I have clients that are typically on track to max out the 401ks, but sometimes they might get a bonus or overtime, and then those checks are bigger, and therefore their contribution is bigger because it's based on a percentage of the check. So take a look at that, because you might find yourself in a situation where you are actually over contributing to your 401ks. Or if you have more than one job, that may happen too. If you're contributing to 2 401ks at the same time, you know, there are some people that have their main job and maybe a small part-time. If you're contributing to both, you could potentially go over the limit. You know, it's not $22,500 per 401k, it's total. So if you do have 2 401ks and let's say they both match, you want to take advantage of them, by all means, take advantage of that match. But just keep in mind that you don't want to over contribute to your 401k, because if you do, then you have to take out the excess contribution before the next tax deadline in order to avoid penalties from the IRS. So it's a lot easier to catch it before it happens. If you do not catch it, there's a way to remedy it by removing the excess contribution, but you don't want to get to that point. So this is one of the reasons why you want to look at your 401k, right? If it's open enrollment, you want to take a look at everything that your employer is offering, because there's a lot of things in there that could be to your benefit, you know, beyond just health insurance. Obviously, usually one of the main things that people look at the end of the year during open enrollment is their health insurance, and that's great. When you're looking at health insurance, see if your employer offers a high deductible plan that offers a health savings account. If so, and if you don't use your plan that often during the year, you might be better off with the high deductible plan that allows you to put money into an HSA. I've done episodes talking about HSAs, and just to give you a quick version of it, is they're a triple tax advantage vehicle basically that you can use. It's designed for health insurance, but you basically save money pre-tax and you can invest it. The investments grow tax deferred, and if you use it for qualified insurance, basically qualified health related expenses, it's also tax free. And if you don't, you can use it as an IRA later after you're age 65 without any penalty, just pay income taxes as if you would on an IRA. There are some heavy penalties, though, if you take it out before 65 and you do not use it for health insurance. So definitely got to keep that in mind. Another benefit is if you have a child care expenses or dependent care expenses, a lot of employers offer a dependent care account. So see when you're going through your open enrollment if that is an option for you so that you can choose that and save some money pre-tax. If you have a plan that it's not high deductible, you may look at the flexible spending account, the FSA. That's also a way for you to contribute money pre-tax if you pay for co-pays, glasses, anything from the pharmacy that's prescribed, things like that. So, and there's a lot of other things that actually are eligible expenses. So if you're spending money throughout the year on medical related expenses, you might as well get the flexible spending account. You can put it up to a certain dollar amount. So you just consult with your employer. The only thing that you have to be careful with that one is that not all of the money rolls over to the next year. So you don't want to overfund it because there's only a certain amount of money that rolls over. So you want to make sure that you get, a good estimate of, what you normally would use during the year for co-pays and prescriptions and things like that so that you don't overfund it. But another great way for you to save money pre-tax. Another one too that a lot of people overlook is a lot of employers have some sort of transportation benefit. I have clients that say they live in New York City and they take the train down to their employer. You might be able to get a pre-tax benefit in order to purchase like the expense. And some of them offer for if you drive in like parking tolls and things like that. So don't only just focus on the health insurance. Make sure you take a look at very carefully every single benefit that your employer offers during open enrollment, because there might be some really good pre-tax benefits. Another thing to take a look at is the insurances that are offered. Typically, most employers are usually paying standard for some short-term and long-term disability, and they might give you a standard amount of life insurance as well in a group plan, but you also have the ability to purchase additional supplemental insurance, either for yourself or for your spouse or your dependents. So take a look at them, because I usually recommend that you buy your own policy outside, but if for some reason you just haven't, then at least sign up for your employer offered one. Sometimes you can get up to like 3 times your salary without any medical questionnaire or anything, which is great, because some people, if you have had some health issues in the past, any insurance that you go for may either deny you or charge you more in a premium, depending on what the situation is, right? Or it might be a little harder to get. But with the employer group health plan, you might be able to get something without showing proof of eligibility, basically, up to a certain amount, typically about 3 times your salary. So that's something else to consider. Another thing that I do with my clients is Roth IRA conversions. So you might have had an old 401k from an old job or something like that, or you may have some pre-tax money in a traditional IRA laying around. I like to do, as much as possible, what's called maxing out your bracket. So as you know, not all of your money gets taxed at the same rate. It goes in brackets, or there's 7 different brackets. A lot of the times when you look at your W-2 income and your interest and anything else you may have, there might still be some room before you hit the next bracket. And that provides an opportunity if you do want to do some Roth conversions, because then you can pay taxes on that conversion today without bringing yourself up to the next bracket. And the benefit of that is, again, I did another episode on Roth conversion, so make sure to take a look at that, is that you convert pre-tax money to after-tax dollars so that later on, if you follow certain rules, you will have tax-free income in retirement. And there's a lot of benefits for that, right? Especially if you think your IRA is going to grow in value. It's a good opportunity now. And again, I highly recommend that you talk to a financial advisor about this, because everything's going to be based on your unique situation. There's so many moving parts. But I wanted to at least get you started on the thought process of, what are some of the things that I should be asking, right? So I'm not going to give you like a ton of numbers, not to make it too confusing or anything. Just wanted to make it thought provoking. So you're like, oh, okay, maybe I should look into this. Have I maxed out my 401k? Have I put money in an HSA? Did I take advantage of all the pre-tax options with my employer? Should I be doing a Roth conversion? If you are charitably inclined, keep in mind the things that you can do before the year's out. One of them, the gift tax exemption is $17,000 per person. So you can gift up to $17,000 per individual without having to file a gift tax return and without paying any gift tax. So that's another strategy that you can use. I have some grandparents that like to give some money to their grandkids. We put it in a 529 at the end of the year and stuff like that. So that's another strategy that you want to keep in mind, just because you're able to do that without having to file a gift tax return or pay any gift tax. Also, if you have investments, there is something called tax loss harvesting. And basically what it is when you have a gain on any investment that you've had, you have to pay capital gains on it. Depending on your income, it could be 0, 15%, or 20%. And a good strategy you can use is if you have had gains, let's say in a brokerage account, and now you have to pay capital gain tax on that, take a look to see if you have other positions in your portfolio that have generated losses, or if you have carryover losses from prior years, because then you can use those to offset the gains on the new thing that you did sell, right? So this is another thing where a financial advisor that has tax knowledge could really, really help you, because they can look at your tax returns, see if you have carryover losses, also see if you have any losses that you could generate now, just looking at what you bought a certain investment for and what it's worth today. They might be able to generate a loss for you for tax purposes. And it's so important to think about this before the year ends, because towards the end of November is when you can still sell those and buy something similar. There's also a 30-day rule. The IRS has a 30-day wash rule where you can't sell something and then buy it back, because they want to avoid people generating losses. But there is a way around that. If you do it before the 30 days, you can sell it and then buy something else, right? So this is another strategy you want to talk to your CPA about, or your financial advisor, or both, right? So don't wait until tax season to do tax planning. You got to do tax planning before the year is out, throughout the year. Also, speaking of taxes, make sure that you're withholding enough. This is another great time right now, as you have a few paychecks left, to say, if you have a CPA or financial advisor, another thing I do with my clients is a tax projection. Plug in all the numbers. How much have you made so far? What are we expecting to get for bonuses and so on? Calculate what the tax return is likely to be next year. You could do that today. And I can tell my clients if they're withholding enough money. Sometimes they haven't for some reason. And then there's a good opportunity for you to then either increase your withholding or send an estimated tax payment to the IRS and or the state so that you avoid any penalties. The general rule of thumb is with the IRS is you have to pay either 90% of the tax due for the current year or 100% of the tax bill for the prior year. If you make over 150,000 or 75,000, matter of fact, separate, is 110%. So I would just do the math and see, let me see what your tax bill was last year. They call that a safe harbor contribution. So you want to make sure that you at least have enough in the safe harbor contribution so that you don't pay any penalty. And again, if you're not somebody that does taxes or a financial planner, you probably don't know this, and it's probably going to be hard for you to figure this out, right? So just want to get those thought-provoking questions, like don't reach out to your accountant during tax season just to do your taxes. Meet with them during the year. Be proactive about this kind of stuff. Also, you have a way of being able to bunch your tax deductions. A lot of people take the standard deduction that the government allows you to take. But if the number that you have is higher, you can take advantage of itemized deductions one year and then take standard deduction the next. So let's say if you had a lot of medical expenses, speak to your accountant and see if these medical expenses get you close enough between that and maybe some charitable contributions, or maybe you can prepay certain things that might allow you to just bunch up all of your deductions so that you can take advantage in 1 year, right? So that's another strategy. That's an oldie but a goodie. So there's just so many things that you can do before the year's out. And one of my favorite times, because I just love planning, right? That's what I do for a living. Also, if you are required to take a minimum distribution from your individual retirement account, for example, a few years ago, if you were over the age of 70 and a half, you were required to start taking money out of your retirement accounts. That law has expanded the age depending on when you were born and all. But ultimately, if you are required to take a minimum distribution, you want to make sure that you do so before the year is out. For certain clients that are charitably inclined, what I have them do is actually take the money out and then we donate it directly from their IRA. It's called a qualified charitable distribution, directly to their charity or charities of choice. And there's zero income tax, because a lot of people take the required minimum distribution, they pay taxes on it, and then they donate the money. And that's actually costing you money for no reason, because you could do a qualified charitable distribution if you're over the age of 70 and a half. So that's a great strategy to use. You can also gift to a donor advised fund and deduct up to a certain percentage of your adjusted gross income. So many strategies. So basically, just throwing ideas out there for you to think about and get that ball rolling. So contact your financial advisor, contact your CPA, and just ask them what are some things that you should be thinking of right now before the year is out. Also just planning for next year. Think about interest rates right now. A lot of us have had the opportunity to put money into a high yield savings account or a CD, a certificate of deposit, which are paying like 5% plus, depending on how many months you lock it in for. The Federal Reserve has not raised interest rates in the past couple of meetings. And a lot of people are already thinking that they might be done raising rates because inflation seems to start taming. If that's the case, when the Federal Reserve then begins lowering interest rates, it's going to be good for a lot of things, right? New mortgages, car loans, personal loans, home equities, line of credit, and so on. But at the same time, those high yield savings accounts that we've been taking advantage of, paying 4.25%, CDs at 5% and so on, those are going to go away. So if you have some money right now that you don't need in the short term, consider putting that into a certificate of deposit, because you might be able to lock in a nice 5% or more interest rate for the next 9, 12, 18 months. So don't wait too long, because when the Federal Reserve starts lowering those rates, you're going to feel the impact, because soon enough, maybe 6 months to a year from this podcast, we're not going to be seeing 5% interest rates on a CD. So you want to make sure you lock that in, because you're not taking risk. It's if FDIC insured up to $250,000 and you're making a rate of return. So if you're thinking of buying a home in the next year or something like that, that might be a good place to put it and park it, so that you're not investing it in the market. You're making some interest on it and it's safe, right? So that could be another great strategy for you to use. So as always, if you have any questions, send me an email, luis@onmywaytowealth.com. Wish you and your family a happy holiday season. Stay tuned for future episodes, especially after the New Year's, when I come back nice and strong with some guests and there's some new things, So thank you as always for tuning in. I really appreciate you guys, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation.